Good afternoon and welcome this afternoon to Long Options, another great webcast from Schwab Coaching. My name is Ben Watson. I'm an education coach and senior manager here for Charles Schwab. I am joined out there in the chat by my good friend Connie Hill, also a 20-plus year veteran of the financial markets. She actually, in fact, used to teach this particular webcast. I'm filling in for Brent Moores today, and I'm excited to have all of you here with me, whether you're in the live version or the recorded version. Connie's there to help out in the chat. So be a part of the conversation, chat in some questions. If you're watching in the recorded version, leave us some comments in the comment section. We'll reply to those as quickly as we can. We're going to talk long options today. There are a couple of little breakouts going on. Maybe we'll look at the possibility of taking advantage of some short-term movement amongst the indexes. And I'll show you what that means here in just a minute as we get into some long options. Plus, volatility is low. That may be, excuse me, a deciding factor in choosing long options. As we get into this discussion, though, a couple of quick housekeeping items we do need to take care of before we get started. Remember that everything we talk about is simply for illustrative and educational purposes only. It is not a recommendation. It is not any kind of advice or endorsement of a particular security or pattern or strategy. Also, remember that options carry a high level of risk. They are not suitable for all investors. Make sure that you're aware of the characteristics and risks of standardized options before considering any option transaction, long or otherwise. Make sure that you understand those risks. If you have questions about those risks, you're in the right place. But it's always a good idea to ask before you get started with something. Hey, we're going to be using the Thinkorswim desktop software platform today. It is, well, in this case, specifically the paper money version of that. Great learning environment. It is a great sandbox to play in. It is not a guarantee of future success out there in the real world. And the paper money platform does not do certain things that the live trading environment does. Namely, does not facilitate the early assignment of short options. There are some other things around studies and charting and things like that that it does not do. But the big thing to remember is if you are short an option, since we're talking long options today, might not come up into the discussion, but if you are short an American style option, the paper money version does not facilitate the early assignment of that option. So that might be a difference that you would realize if you were to move to a live trading environment. Now, remember, investing involves risk, including the loss of principal. When we talk about stops, remember that there's no guarantee that the execution of a stop order will be at or near the stop price. And in the event of a stop limit order, there's no guarantee that the execution will take place given price movement. Past performance of any security or strategy does not guarantee future results or success. We're going to be talking about a lot of different things, including probability analysis today. All of those are theoretical in nature. None of those are guarantees as to what the market is going to do. But as such, Schwab doesn't recommend the use of technical analysis as a sole means of investment research. So something to pay attention to as well as when you go into your discussion of the stocks that you are going to trade and make your own decisions about. So let's do this. Let's jump out to the Thinkorswim desktop software platform really quickly. Good opportunity for me to remind you to click on the subscribe button down there at the bottom of the page and be a part of the conversation, be a part of the community. It is a no-cost subscription to you. Give us a follow there. It helps to bring the content up to the top of the page. It also allows you to set alerts for new content that gets added or archives that get dropped into that Trader Talks webcast page, which I will show you here in a little bit. Now, John the Noble Savage asks a great question when we talk about long. He says, how long is considered long? And therein lies one of the challenges when we talk about long options. And I know John knows this because we've had this conversation before. But in this particular environment where we're talking about long options, the word long, L-O-N, N-G, does not reflect the length of time that we are in the option trade. It does not speak to time frame. It speaks to the characteristic of whether we are buying the option or whether we are selling the option to open transaction. So long, in this case, means buy. We're buying the option or going long the option, in this case, to open the transaction. So in that particular case, short would be selling to open the transaction. So when I make those distinctions, when I use those words long and short, now you've got a good understanding of what that means. Now, long dated, there are long dated options, and you'll often hear Connie or myself or other coaches refer to those as long dated options instead of just long options, because to avoid that confusion between buy and sell, long and short, long dated or short dated options refer to the time frame. We'll talk about duration or how long dated those options are as we get into this discussion. So I wanted to look really quickly at what's going on in the market, just kind of broadly to give us a sense, because then I want to kind of come back to this here idea really quickly. So taking a look at the SPX, we've got a little bit of a, well, continuation to the rally. We kind of come over here to the right-hand side. We'll zoom in a little bit here. Friday was a big rally to the upside. And then we see this little bit of a pullback. And then we see today a little bit of a bounce. And I'm going to zoom in a little more closely here. I'm actually going to kind of stretch this out a little bit, and we'll zoom into this range right here so you can see Friday's candle. And the thing that is kind of impressing upon me at this particular point on Friday's candle is the fact that that midpoint of Friday's candle, if we were to kind of subdivide that big green candle in half, is oftentimes the midpoint of a big green candle like that, or a big red candle for that matter, may act as a level of support or a level of resistance. And the situation here at this particular case is price is pulling back, or has pulled back. It opened down a little bit and then started to rally. So we got a little bit of a gap down and rally today. And that came down to that midpoint of that green candle and seems to be bouncing up off of that. That suggests that maybe there is a little bit more bullishness here. If it had broken the midpoint of that candle, maybe looking at a little more bearishness in the short term. A lot of different ways to look at that, a lot of different techniques to evaluate levels of support and resistance. In this particular case, we're using the midpoint of that green candle. Coming back over here to the Russell, or to the NASDAQ, to the more technology heavy of the indexes, rally up, sideways, never breaking below the midpoint of that candle, but still bullish, but running into some resistance. So maybe a little bit more influence from that level of resistance than from the potential bullish bounce. The other one, which is the Russell 2000, the small caps in this particular case, same kind of thing. And we see where that previous resistance was. If I were to activate that previous resistance and kind of continue that line over to the right, you're going to see that that line falls just about the midpoint of that big green candle, again acting potentially as a support level. A little bit stronger move to the upside today in the small caps. A little bit more momentum to the upside, breaking above the previous resistance of yesterday's high and starting to maybe see a little bit of rally. So if we're looking for some breakouts, we might see those occurring here in the Russell 2000 amongst the small caps, but there may be some breakouts elsewhere as well. Now, the other thing I wanted to look at when we're talking about trading long options, the reason I center our discussion initially on the broad market is the biggest influence in a directional option trade, meaning a long call or a long put primarily, meaning we're buying the option to take a directional speculative expectation. Buying a call if we speculate that the price is moving higher. Buying a put if we speculate that the price is moving lower. The biggest influence on those trades is going to be initially directional price movement of the underlying stock. And if we can get the directional price movement of the market moving in the direction that the individual stock is moving, that gives us a greater probability of success in a long option trade, because we are utilizing kind of that confluence of those forces, if you will. Market moving up, stock moving up, that benefits a long option trader, specifically in this case, a long call option trader, buying a long call option to expect directional upside movement. Now, the one other thing I want to talk about here is volatility. So I'm going to bring up my VIX grid. When we talk about volatility, volatility is oftentimes measured by using the VIX, the volatility index of the S&P 500. There are a lot of different ways to interpret the VIX, but by and large, here's the interpretation of the VIX, this volatility index. When there is fear of adverse movement in the market, meaning when there's a fear that the market is going to move down, institutional traders buy put options on the SPX index to provide hedging protection against long stock portfolios. It's more efficient to buy that protection on one product than it is to buy it on individual products. And so when there is fear in the market, either ahead of that fear or after the catalyst for that fear has occurred, they will buy those protective options that will increase the price of those options, and that drives the VIX higher. It's often reactionary, not very often proactive. And so we're seeing kind of that same scenario here. So here we are, end of summer, end of August. We've got a Fed meeting coming up in a couple of weeks. We've got a big tech earnings announcement coming up tomorrow. There is the potential for market movement. And yet the fear gauge, or this VIX, this volatility index, is still very low. We're at the 14.89 level, the 14 handle, high 14s in this case. And that's nearly as low as this VIX has been in some time. In fact, nearly as low as the VIX has been all year. So volatility is low. Now, here's what we also know about volatility. That in general, when volatility is low, either individually or collectively, when volatility is low, it tends to rise. Now, as the buyer of a long option, either buying a long put or buying a long call, low and rising implied volatility is a benefit to our long option position. Whether we're buying calls or whether we're buying puts, doesn't matter. So low and rising implied volatility. So we're kind of in a sweet spot here from that standpoint. Again, not a recommendation, but we're in a sweet spot from the perspective of volatility. If volatility were to rise, that would likely benefit long options, as long as it doesn't counter directional price movement. Because typically the VIX rises when the market moves down. But remember, we've said that we were bullish. Now, we can have VIX up, volatility up. We can have VIX up, market up. That can certainly happen as well. And again, then it comes down to individual stocks as well. So we'll look at stocks that have implied volatility levels that are low with the potential to rise as an almost ideal or potentially ideal scenario for trading a long option. So I've got a couple of examples that have been moving in a directional fashion that may be benefiting from a bullish market and a potential rise in implied volatility. So let's see what that looks like. So I'm going to pop over here to my single grid. And this is just my playground kind of sandbox that I use in a number of cases. So we're going to look at this particular stock. This is GD, General Dynamics. And General Dynamics, if you notice, there are a couple of things going on here. One, today it is seeing a directional breakout above a previous level of resistance. Two, it's got a bullish trend. It's been moving higher. Around this last earnings announcement, we saw a pullback into the earnings and we saw a gap up and rally off of that earnings announcement. That rally on the earnings announcement took the price to settle right here at about the 320 mark, which is just about where that resistance level is that the stock is breaking out of right now. So what that suggests, the fact that we're getting a breakout right now, is that there are buyers here that didn't feel comfortable buying back here, but now that this has held a level of support and it's rallied back up, they feel comfortable stepping in as this breaks out again of that previous resistance level. We're past the earnings announcement, so volatility has decreased But now look at what volatility has been doing in the last couple of days off of the bottom here. So volatility has been very low. Volatility tends to be mean reverting. So when volatility is very low, it tends to rise. And that's what we're starting to see happening here, even though the market is moving higher, even though the individual stock is moving higher. One of the reasons that the volatility could start to rise is because there's more speculative pressure. There might be more buyers of options stepping in. There might be buyers of put options to protect a position. There might be buyers of call options to speculate, which is what we're going to do in this particular case. When there are more buyers of anything, I don't care if it's glasses of lemonade from a kid selling it on the corner, or if it's gasoline at the gas station, or if it's milk at the grocery store. When there are more buyers of those things, prices go up. That's the immutable law of supply and demand. So if this implied volatility is rising, one of the implications that we can take from that is that the price of options is getting more expensive. That's kind of the implied part of this. It doesn't mean, by any means, it does not guarantee that the market is going to go higher, that the individual stock is going to go higher, what that next tick of that price is going to be. But neither does trend, neither does a breakout of resistance. We're putting probabilities in our favor here. We're trying to find a highly probable trade. And that's kind of what we've got here from that standpoint. No, not a guarantee by any means. But it's giving us that perspective of how we might take advantage of this. Now, we could just simply buy the underlying stock. But buying the underlying stock, if we were to just create an order to buy the underlying stock, and we were to buy 100 shares, if that were our default, we're going to tie up $32,181 of cash in our account, capital in our account. That's what it's going to cost to buy 100 shares. That's not necessarily the best capital efficiency, but there are other reasons why we might buy individual stocks. Individual stocks don't expire. They might bring dividends, but those aren't guaranteed and they can change. And they might bring shareholder rights, but those can change too. So the one benefit perhaps of buying long stock is that it doesn't expire. You can hold on to that long stock for a long period of time, but it's a one-to-one relationship. If this stock goes up $1, we're gaining $1. If the stock goes down $1, we're losing $1. And we know that if this were to go to zero, if General Dynamics were to go to zero, we'll probably have bigger problems. But at the same time, we could potentially lose $32,181. So we got to keep that in mind. That's not a very probable scenario here, however. But we're not going to do that. We're not going to buy 100 shares of General Dynamics. We're going to buy a long call option to speculate on that upward price movement. Now, a couple of things before we do this. I want to kind of put into perspective here. I'm going to zoom back out. I want to put into perspective how far this stock might move. So number one, I'm going to look left to confirm what I'm seeing right. So I look back over here on the left. Are there any previous, in the recent past, any previous levels of resistance that I maybe want to pay attention to? And there are none on this particular chart. So looking left to confirm what's going on right, we're breaking up into some clear air. Some area without resistance. And that scares a lot of traders, to be fair. It really does. And as we open this up, I'm going to take this to a little bit longer time frame. 3-year weekly. We'll go to a 3-year weekly. And I look back over the last 3 years, and there's no previous resistance. This is breaking out to a new, at least 3-year high. We could probably even argue, I'll bet that it's a new all-time high. If we were to go out and change our time frame out from 3 years, let's go out to 20 years and click on OK. Yeah, new all-time high for the stock. And your brains are screaming, I can't buy a stock. I can't place a trade. I can't buy a long option when it's at an all-time high because I don't know where it's going to go and I don't have any definition of where the next level of resistance might be. Oh, the horror, the humanity. Okay, here's what we're going to do. We're going to say, look, we're going to look at past movement in the price of the stock, and we're going to couple that with what the market's expecting to set a potential target for this trade. So I look over the course of the last 2 months, or the last month and a half here, and I see how far the stock has moved. I can draw a line here from a support level right about here. And I can draw that line right up here to the top, and that's a symmetrical move, right? That's a range in which this price has moved. I can duplicate that line. You've seen me do this before in a number of cases. You've seen Connie do this before. Connie talks about this all the time. Brent talks about this all the time. This is nothing new. I just duplicated that line. I made it a symmetrical move here to the upside. 332.29. I don't like that number. I'm going to give it a little bit. I'm going to say 333 is our target up here. 333. So I'm going to put that in here. I'm going to put a little label on it. 333. That's the potential move to the upside. Okay, cool. How far might it move to the downside? Well, to be fair, it very easily could move down to this 308, but I'm not as concerned about that because I'm not going to put a stop order on this, and I'll tell you why in just a moment. We're going to go to the trade tab now. Now that we kind of have an expectation of how far we think this might move before it runs into some significant resistance, and we know that implied volatility is relatively low, now we're going to go to the trade tab. And we also know that by looking at that chart, let me bop back there really quickly, that for this to make that move, it's taken about a month, maybe a month and a half worth of time, okay? So to get to that target, it may take a month and a half, it may take 2 months. I'm going to give it a little bit more time than I think I need in this particular case. So we're going to go to the trade tab and we're going to bring up GD, General Dynamics. Now, somebody asked the question about volume. And so Vic asked the question about volume. There are two components to this volume. Number one, the volume of the underlying stock. Now, this underlying stock trades with about 500,000 shares daily volume. Now, that's today, right now, is that number being displayed. Knowing this stock, I know that it trades with a little bit more than that, generally on average. Volume is a little bit low today across the board. It's just kind of a slow day. So this trades with closer to 1 million shares. You might have a personal filter that you say, you know what, I don't want to trade stocks that have less than 1 million shares average daily volume. Now, the next answer to this question, the next answer to this particular question is this. Well, what about the individual stock, the individual options, the strike prices? What about their volume? So remember we said that we think the trade's going to take maybe a month and a half, maybe 2 months. So you know what I'm going to do? I'm going to come out to these options out here that have maybe been trading for a little while. And I'm going to look at buying more time than I think I might need. I'm going to go out to the 17 October expiration, maybe even to the 21 Nov expiration. Let's just take a look. So I'm going to open up the 17 October expiration. And I'm going to look at the number of strikes here. I'm not going to go too far outside that realm of 14. That's 7 strikes in the money, 7 strikes out of the money. And I've got my layout displaying volume and open interest. So volume and open interest is interesting because volume expresses the number of transactions occurring at that strike price today. Open interest expresses the number of open and unexercised contracts at that particular strike price. Now, I know that there are lots of different ways to evaluate this, that you maybe take the width of the strike price and you want to say that you want to have a certain percentage of that in terms of open interest. The number of contracts is the number of relative to the number of contracts of open interest, the number of contracts that you're going to trade as a percentage of that. I just want to display it as this, okay? So here's what we're going to look at. We're going to look at being a small fish in a big pond. Small fish in a big pond. That's the way that I refer to this. If I'm a big fish in a big pond, I'm making up the majority of the market. If I'm trading 1 or 2 contracts in a pond that's 14 contracts large, or 19 contracts large, or 59 contracts large, I'm not making up the bulk of the market. If I'm trading 1 contract in a pond that's 500 contracts large or 1,000 contracts large, I'm not making up the bulk of the market. But if you're going to come in here and the pond is 14 contracts and you're going to try to buy 20 contracts, then you are a big fish in a little pond. And we don't want to be a big fish in a little pond. We want to be a little fish in a big pond. Whatever the size of that pond is, we want to be a little fish in a big pond. That's it. That's the way that I think about this particular relationship. There's not a specific percentage rule of thumb, or there maybe ought not to be, perhaps. because it's relative. So I'm okay with that kind of liquidity. Now, what I wouldn't do perhaps is go deeper in the money to these strike prices that have zero contracts of open interest. Could you trade it? Yes. Are you going to be treated kindly by the market makers? No. You can still fill that order, and they'll fill that order. That's their job. But you're not going to be filled at the price that you expect. Same thing way out here, out of the money. You buy those, they're going to be cheap, but you're not going to get a good fill price because the market maker is not going to be kind to you at that level. But you buy one in here at the, these levels right here, you're probably going to get a fairly reasonable fill. Now, notice something. This at the money strike is not that wide. The bid-ask spread, the slightly deeper in the money, the 310, a little bit wider, maybe not as fair pricing, lower open interest. So if we were going to buy an option here, buy a long option, we might buy one that has that narrower bid-ask spread. It makes that pond a little more attractive, right? This pond here, the one that's $2 wide, probably suggests that this pond is a little bit brackish, not really clear water, if you will, from that standpoint. Even though it's a big pond and a small fish, it's not the most desirable pond. Most desirable pond, at least in this relative relationship, is this one that has the narrowest bid-ask spread, the greatest amount of open interest were the smaller fish in that bigger pond. So you can kind of see how that relationship works. Now, I'm going to double check one other thing here in this relationship. I'm going to look at that next expiration cycle out, the 21 November expiration. And I'm going to say, hey, you know what? Could I buy a little bit extra time for the sake of getting a little bit tighter bid-ask spreads? Yes, it's going to cost more, but the pond might be a little more desirable. So I come out here and I take a look at the one that expires 87 days to go, another month worth of time. And I look at the number of contracts. Now, here's the thing to think about. Even if I have a larger number of contracts being traded, a lot of that is going to be determined by the width of the bid-ask spread. So here's the thing. If we come back, this is a tighter bid-ask spread than the others here. If I come back to the 17 October at this at-the-money strike, even though it's only got 52 contracts of open interest and not 500 contracts of open interest, it's got a tighter bid-ask spread. So I'm probably going to choose this one. So RT asks a question. Since we expected to go 333, wouldn't the cheaper 330 call be better? Great question. Great question to ask. Yes, it would be cheaper. However, let's change our layout to intrinsic and extrinsic value. And let's talk a little bit about these two. So the 320 strike, the one that we're potentially looking at buying, that 320 strike, this one right here, has $1.40 of intrinsic value, right? $1.40 of intrinsic value and $7.15 of extrinsic value. Whereas the 330 strike has $3.70 of extrinsic value and no intrinsic value. Now, this is maybe where there's a little bit of a philosophical difference, because here's the thing. When we're buying an option, one of the considerations might be we want to buy something of tangible value, meaning the intrinsic value in this option contract. Intrinsic value is simply the relationship between the strike price and the stock price. It's that mathematical relationship. Intrinsic value doesn't decay away. Intrinsic value doesn't change because of implied volatility. Intrinsic value doesn't change because of changes in interest rates or gamma. Intrinsic value only changes if the underlying stock moves. So if I'm buying an option, generally I want to think about, as a trader and as a speculator on price movement, buying something that has a little bit of intrinsic value or has some tangible value, as opposed to buying something that has no intangible value. Because if the price of the stock were to not do anything and I were to let it go to expiration, if I were to buy the 330 strike versus the 320 strike, Buying the 330 strike, if that were to go to expiration, I would have nothing left. It would be worthless. If I were buying the 320 strike and that were to go to expiration and didn't move at all, I would still have $1.39 or $1.40 of intrinsic value remaining, even if all of that $7.16 decayed away. I still have something left I can sell back to somebody else. So that's one of the considerations for buying an option. If you're speculating, if you're a long option trader, buying an option that has some intrinsic value, has some value to it. So as we look at this particular example, we're going to look at buying the 890, or excuse me, the 320 strike. Now, here's the thing to think about. One of the things to think about. Notice with this particular expiration date, 17 October, and in fact, all of these expiration dates, there's a number over here on the right-hand side. That's implied volatility for that particular expiration. Next to that is a plus and minus. And that plus and minus is an absolute value price. It says that based on the current value of these options, the current pricing of these options, as is priced by the option market right now, the expected move. Now, this is a proprietary calculation using variables from the Black-Scholes calculator. That plus or minus $15.83 suggests that the expected move, the move that the market is expecting, the options market is expecting, is up $15 or down $15. So here's the thing. Let's go out to our chart. We're at 320 and we're expecting it to move to 333. That's $13. That expected move that we put on the chart is inside the expected move of the options market. And that's a good place to be. Simply from the standpoint that if the options market is expecting it to move further than my target, then I'm not stretching by setting a target that I would look at taking the trade off at 333. So it's within that expected move, and that's a good confirmation or double check of this particular scenario. So we're going to go ahead and we're going to place this trade, and I'm just going to simply go to the ask price and left click on the ask price. Here's our option. We're going to read through this. So yes, to answer Otto's question, could you enter a limit order at the midpoint between the bid and the ask? Yes, you could. You can work this order. We could work this order right now just by sliding that slider down to that midpoint, which is going to be the midpoint between the bid and the ask. And here's a little secret. In paper money, we're almost always going to get filled at the mid. In real life, we're probably going to get filled closer to that natural or closer to the ask. That's just the reality of the situation, especially in a slightly less liquid market. There's nothing wrong with that. But there's also nothing wrong with working working that order a little bit to try to get into the trade, recognizing that the opportunity cost of not getting into the trade is the trade-off there. So I'm going to put this at the natural so that we can potentially get filled. I'm actually going to open that lock up a little bit so that it floats, and we're going to click on confirm and send. We're going to read through this order. Here's the thing that tends to seduce option traders towards long options. Infinite maximum gain. That infinite maximum gain in this potential trade. Well, okay. The likelihood of General Dynamics going to zero is about the same as the likelihood of it going to infinity. Got to put it into perspective. But our maximum loss in this particular case is not $32,000, it's $890. And if that is smaller, or excuse me, if that is too large for the position size and the risk that you're willing to take, it might be better to change the stock that you're looking at, change the strike price that you're looking at to adjust, as opposed to putting a stop order on here. Because here's the thing. If we were to put a stop order on that option and limit that to say 50% of that potential gain or that potential loss in the trade, there's a very real possibility that intraday, or especially with a slightly wider bid-ask spread, in the morning when the options market starts to get moving, because it goes in kind of a round robin fashion and gets working, if that option market widens out and you have a stop, there's the potential that that order could kick you out, and then the stock could continue to go on and do what you had expected it to do regardless, and you got kicked out on a stop. So oftentimes traders in this particular case will simply manage their position size, not by using a stop on an option trade, but managing to that theoretical maximum loss. Again, your choice, your possibility, whatever you want to do. So I'm going to put this down in our market movers group just so I know where it's going. I'm going to read through the order, make sure that that's what I want it to do. Read the order twice, then trade it once. Read the freaking order so that you don't inadvertently place an order. I'm going to click on send and we're going to fire that order off. And we got filled. And so we're in. And we got filled, if you notice, at $8.55, which is the mid price, because it's paper money. So don't be concerned. Don't be unaware when you place a trade in a live trading account and it gets filled somewhere other than the mid price when all you've been doing is trading in paper money. Just be aware of that. That's one of those differences that I pointed out when we were talking about this. So there's our long position there, right? Now, I wanted to do one other, given that potential breakout in this particular case, and that was along the same lines. This is GE, and we'll look at the difference in terms of liquidity, because GE arguably is a little more liquid. Let's take a look at GE. And GE is giving me not so much a breakout here as a bounce. So trend is moving higher. Let's kind of zoom in over here. Implied volatility, though, kind of pulling back still. So implied volatility is still low, but with the potential to rise. And we're looking left to confirm right. Whoops, let's draw the line here. Looking left to confirm right. And you notice what this is doing off of that level of support. We're getting a little bit of a bounce, maybe a close or a trade above the high of that low day. If that's our low day, we've got to trade above the high of the low day and the potential for this to move to the upside. Now let's take a look at where we've got some resistance levels just to kind of set that target. Easy target right up here is at about 281. I'm going to take 281 and I'm going to put it in there. That's an easy swing target if we're looking at a swing trade off the support up to that resistance. I know by looking at this stock and having looked at this stock quite some time that to go back to the left, if I float this back up again, that I don't have previous resistance levels in the recent past. So the other thing that we could do, if we were looking at this making an even bigger move, is we could take that distance once again, duplicate it, put it up here on top, and say, all right, where is that next range? That's at 297, 298, somewhere about there. So the stock's at 271. I'm just going to use my calculator so I don't get this wrong. 271, whoops, 298 minus 271, 27 bucks. All right, so let's see what that looks like then when we go to the trade tab. So the last, one last double check here is it made this move over the course of, again, about a month. So we're going to be looking out maybe a month or 2 months. That tends to delay that length or that rate of time decay, which is a subject of the option Greeks and the option Greek specifically theta. Let's go to the trade tab here and look at, so this is about 1.5 million shares traded today. So I'm going to go out actually again to that 17 October expiration. And I'm going to look over on the right-hand side and looking at that 17 October expiration, that's about a $24 move. $25 move. We expected a $27 move. So we're pretty closely aligned. So I might detune that expectation a little bit for that move out to about $25. And say, cool, maybe this moves 25 bucks from where it is right now to that target. So now I'm going to open up this option chain and you can see the narrowness of these bid-ask spreads. Let's look at volume and open interest. So bigger ponds, more fish playing in the pond today. So we're going to look at, in this particular case, yeah, for sure, Rich, you can put an alert on there. So we're going to look at an expectation here. We're going to go a little bit deeper in the money here. We're going to buy an option that has a little bit more intrinsic value. We're going to buy an option here at the 260 strike. Now, you're going to say, wow, that's really expensive, but it's less than buying the underlying stock. I could buy an option that's out of the money that's really cheap, but it doesn't have any intrinsic value. And if it doesn't do anything, then that's gone at expiration. The other thing is that might be a bigger percentage move or bigger percentage gain if the price of the stock does make that move that we set out to 290 or out to 300. But if you think about it in terms of the possibility of loss, if the stock doesn't do anything, we have the potential to lose everything in that case. If we buy this one in the 260 strike, now we've got a little bit of intrinsic value in this particular case to take advantage of. If the stock does nothing through now till expiration, there's still a little bit of intrinsic value. We're buying something of tangible value, that intrinsic value. So we're going to go ahead and we're going to put this trade on. We're going to look at this trade. We're going to click on confirm and send. The trade is going to cost us, again, $19.25. That's our investment in the trade. That's our maximum theoretical loss in the trade. The idea being that if this goes up, we make money on the trade because these call options get more expensive. However, we're going to be battling time decay, but we bought a little bit more time so that we can have some time. We're not up against expiration. We've got some time for this to work and do what we want it to do. Infinite maximum gain and the likelihood of GE going to infinity and beyond, not great. It's about the same as infinity going to GE going to zero. So we're going to put this trade in our market movers. We're going to click on send. We're going to fire that order off. We got filled at the midpoint, which is great. I mean, it's nice when we're in paper money to get filled at that midpoint, but recognize that that's not always going to be the case. And we're going to look at these two trades to make that move continuing to the upside. Now, implied volatility in both of these cases very low with the potential to rise because implied volatility is a mean reverting instrument. So if you want to learn more about these topics and about these ideas, come on over here to the Trader Talks webcast page, youtube.com/@Trader Talks webcasts. And there are a couple of things you want to search for. Greeks. Option Greeks, taking a look at the beginner's guide to option Greeks taught by none other than Brent Morris. We've got Getting Started with Options, Barbara Armstrong teaching option Greeks. You've got Cameron May talking about Greeks. You've got me talking about option Greeks. So lots of discussions about option Greeks. Let's also talk about expected move. Pop that in there. And look at there. There's Connie right there talking about joy from the trades that don't move as expected and are still profitable. Some great stuff there. Click on subscribe here. Follow us on the YouTube page. It is a no-cost follow to you. Why the 260, Josh says, instead of the 270? A little bit more intrinsic, a little bit less extrinsic, a little bit tighter bid-ask spread, more value remaining if it does what it is likely to do, which is just do nothing, if that's the highly probable scenario. And so we've got a little bit more of intrinsic value in that particular case. So once again, guys, thanks very much. Keep these things in mind. Remember that speculative options trading is based on probability, and you got to get things right. You got to be right directionally. You got to be right in the velocity and timing on the trade and the magnitude of the trade, and you're always fighting time decay. I'll tell you what, though, my friend Connie Hill is one who is defying time. So thank you for being here. Thanks to all our great producers as well for helping out. And thanks to all of you for being here. We will see you guys again very soon. Take care and have a great day. Bye-bye.